Welcome to the 5 and 5 option trading series. We're making 5 videos over 5 days, roughly 5 minutes each, to teach you about option trading. This is day 3 where we're going to cover option spreads. This series is being created by the Weekly Option Podcast. Each week we explain 3 new trades that you can add to your account this upcoming week, and we discuss the results of the trades from the last show. You can find us on iTunes, Google Play, or Stitcher, so please subscribe and have a listen. So today we're going to discuss spreads. So what is a spread? A spread is made up of 2 or more options. You typically have a buy and a sell. It can be a way of limiting exposure in a position, and we will discuss in this video basic call and put spreads. Now, pricing a spread is important to understand. So you will buy one option and sell the other. So the price of the spread is the difference between the prices of the 2 options. So for example, let's say you buy one XYZ December 25 call for $2 and you sell one XYZ December 30 call for $1. So the total spread price is $1, which is $2 minus $1. Now, what is the value of the spread? The maximum spread value is the difference between the strikes. So in our example, you have a 30 strike and a 25 strike. That's a $5 difference. So you have a $5 maximum value per spread. This is the case both for call spreads and for put spreads. Now, when you buy a call spread, you're expecting stock prices to go higher. You're going to buy the lower strike, meaning closer to the money, and you're going to sell the higher or further out of the money strike price. You'll pay a premium at the start of the trade because you're buying it. Now, when you sell a call spread, you actually expect stock prices to go lower or stay the same. You'll sell the closer to the money or the lower strike option, and you'll buy the further out of the money, the higher strike price of the call. And you're going to collect a premium at the start of the trade. So when you sell a call spread, you actually receive money at the start. Now, the risk is going to be the maximum value of the spread, which is the difference between the strikes. So when you buy a call spread, the maximum risk is going to be the amount of money you paid for the spread, just like if you buy an option. And when you sell a call spread, your maximum risk is the difference between the strikes, which we mentioned as the maximum value of the spread, minus the price, the amount of money that you sold the spread for. So if you sold the spread, if you collected $1 when you sold the spread, but it's a $5 maximum value spread, that means that your maximum loss in that scenario is $4. And put spreads are similar. So when you buy a put spread, you're expecting stock prices to go lower. Just like when you buy a put, you expect stock prices to go lower. You would buy the higher strike or closer to the money put, and you sell the further out of the money put option, which is going to be the lower strike option. You will pay a premium at the start of this trade. Now, when you sell a put spread, you're expecting stock prices to either go higher or stay the same. So you would sell the higher strike put, which is going to be closer to the money, and you would buy the lower strike put, which allows you to cap your risk. That's going to be the lower strike option. And you're going to collect money at the start of the spread or start of the trade. So the risk, of course, is the maximum value between the 2 strikes. So the maximum value of the spread is the difference between the strikes. So your maximum risk when buying a put spread is the amount of money you pay for the spread. Just like when you buy an option, your maximum risk is the amount of money that you actually pay for the option. Your maximum risk when you sell the put spread is a little different. It's going to be the difference between the strikes. So that's the value of the spread again, minus the money that we receive. So just like in the situation where we sell a call spread, let's say the maximum value of the spread is $5 and we receive $1 when we sell it. That means our maximum risk on selling that spread is $5 minus $1, which is $4. Now, I know I'm going through this kind of fast, so if you have any questions, feel free to email me directly at eric@theweeklyoption.com or visit our webpage and Definitely subscribe to our podcast, theweeklyoption.com. Tomorrow we'll discuss volatility spreads. See you then.